Okay.
So let's go.
So you guys had the chance to do pile quizzes, or at least look at pile quizzes. Hopefully it doesn't say anything like tonight. What questions are there? You gotta have questions. It was that straightforward. Truly. Come on.
I'm looking at my notes.
Okay, no worries. Uncomfortable silence for a while.
The market value. Oh, we're talking about the quiz?
Yeah, basically what we kind of blasted through in this class is unfortunately fire hose normally, and it's far worse when it's in this blended online format. We basically said, okay, last week was chapters 1 through 4, which is really the basics of finance and time value of money. And we spent most of our time last week on the Excel piece of time value of money, trying to get comfortable with that. And so, as you were going through the quizzes, what came up where you're like, hey, I'd like to give this thing a little bit more practice, or I'm not 100% sure of X, or can we review what's going on any of the stuff that we covered? Because we didn't cover things like ratio analysis, we didn't cover, and again, the way I've tried to design the course, and it's a tough, this course is tough, so, and again, we'll be merciful with, is really going, okay, do the work, do a lot of it on your own with the prior recordings, since we only meet once a week, prior recordings, the book, and the quiz. And then we'll take the first part of the class to go, okay, what questions do you have that we should be working on together? Can I go, you two pair up, and kind of work through some of the questions that came up? If we don't have any, you guys are like, nope, I get it. I ran through present value, I'm in good shape. I ran through time value of money stuff. I can do the Excel things and feel pretty good about it. Then I'm going to cover a few other components from chapter 2, which is really the ratio analysis piece, which is going to help you get ready for, kind of the real world of this. And then we'll dive a little bit deeper into some of the stuff going forward. But the intention is really for these classes to really be more retrospective, to look back at the assignment and go, okay, what do we need to spend some more time on?
So we can go over the Excel portion.
Go over the Excel.
That was an old, yeah.
Okay.
I was like, this is not right.
Okay.
So let's go through a couple. We'll go through a couple Excels, and then actually, does everybody have at least Excel or Google Sheets? Okay. So what we'll do is, instead of me going through the Excel, we'll go through a couple. I'll put a couple problems up on the board, and I'll have you guys do them at your own computers, and then I'll basically walk through and go, okay, did you get it? Did you not get it? And let's take a look. So you guys will actually, instead of having me stand up here and do it, we'll have you all do it, and then make sure that you've got it.
The other thing that kind of made it a little bit harder too was, in the textbook, all of his examples were financial calculators.
Yeah. And the world, I actually did bring one this week. I do own one from the dark ages. So this is the financial calculator. This is a classic HP 12C financial calculator. I haven't actually used this thing. This is like 5 years ago, the company I worked for. So I haven't actually used this thing in that long. But my other class was like, have you ever used a financial calculator? Do you still use a financial calculator? I'm like, oh yeah, I got one. I'll have to find it. I don't use it anymore. So yeah, everything, that's the one gripe, one of the gripes I have about the book, is it really focuses on this financial calculator concept, and the world uses Excel. But I'll take a couple examples and we'll go, okay, how do we get to it with the right answer using Excel? When you guys were going through the, kill this and put the screen up. When you guys were going through the, were there any problems in there that specifically bogged you down? Any concepts in there? Yes, ma'am. We will, but I figured if there's one of those problems, we can throw it up here in Excel as well.
I have the question that I got wrong on the quiz.
Okay.
Okay. Pearl Automotive Limited has a current ratio of 2. The company wants to window dress its financial statements. Which of the following transaction will increase the current ratio? I guess it's not like a numbers problem. Current ratio of Pearl Automotive, assuming all other variables remain constant. So what I selected, which was incorrect, was collecting accounts receivable, and the correct answer was repayment of short-term loans.
Yep.
So I guess I was just a little confused on the concepts there.
Okay. So the current ratio is the ratio of current assets to current liabilities. So what's included in current assets?
Equipment.
Cash, equipment,
Not equipment.
no equipment.
No, cash, inventory, accounts receivable. Those are going to be your big ones. What's in? So that's your current assets. What's in current liabilities?
Debt.
Debt. Accounts payable. You're.
I'm on the right track?
Oh, you're 90% of the way there.
Unpaid debt? I don't know.
Debt that's due within a year.
Okay.
So it's basically, it's going to be your accrued expenses, so payroll, payable, your accounts payable, and current portion of long-term debt. That's that which is payable within a year. So you've essentially got all these current assets over current liabilities, and that's 2/1 in this particular case.
Yeah.
So if you collect it, and we'll go to your incorrect answer first.
Yeah.
If you collect accounts receivable, so let's say this is actually,
Like that, it makes sense to me. Yeah.
so let's say it's 200/100. You collect accounts receivable, you're basically taking one current asset and replacing it with another. You're taking accounts receivable down and cash up. So this 200 doesn't change, because this is cash plus accounts receivable plus inventory. Down here, you've got AP plus accrued expenses plus current portion long-term debt. So if you said, okay, I'm going to take $10, well, let's take $50 because it makes my math easier. If you say I'm going to take $50 out of cash and I'm going to pay down current portion of long-term debt, what happens to this number? If I take cash down by 50, what does this number become?
150.
150. And if I take this number down by 50, what does this number become?
50.
So now what's the current ratio? 3. And so that's what they call window dressing. And we didn't get into one of my favorite chapters. One of my favorite things in finance is chapter 2, is a ratio analysis. It kind of, I kind of equate it to, how many of y'all seen the movie Beautiful Mind? The John Nash story? Where he's got all the stuff and he's like got it all up on the wall and he's got crap flying all over the place and strings going from here to there. That's how a ratio analysis feels to me. You take each one of these little things and you throw pieces of it against the wall and pretty soon you get this big picture and stuff starts popping out like, oh, that's what the company's really doing. And the example in the book really kind of flows through and gives you this deep picture of a company, Unilite, and how Unilite's doing. So in this particular case, one of the things that companies look for is what's your current ratio? You know, because the higher it is, the more liquidity you have, the more likely you are to be able to pay your bills. How you doing? No worries. And so then you come back and you go, okay, the current ratio is now 150 over 50. It's gotten much better. Is the company in any really much better position? No, it's really the same. But if you just take that in isolation, it makes the company look better because the ratio is better. And they call that window dressing because really it did nothing to the fundamentals of the business. It may have actually hurt the fundamentals of the business because now they don't have any cash. But it makes the ratios look better. And someone who doesn't kind of dig a little bit deeper on the analysis is going to miss that. So from a math perspective, you can see what happened. Policy perspective, that window dressing is important because it's really the perception of how well the company is being managed. And generally, this number being higher is better. What other questions? And then you said the Excel piece, but kind of roll me through a question. We can walk through it, otherwise I'll pick one out of the butt.
There was a question about the market value.
Okay.
Price shares. Can't really, I don't have a problem, but it was one of the quizzes.
It was one of the quiz questions.
Yeah, quiz questions.
Okay. So I'm gonna pick one out of here, and we'll do it. I'll have you guys each do it, and then we'll walk through it together, or I'll have somebody kind of walk me through it, and we'll see kind of where we come out.
So we're going to go with this as the question. Kim deposits $100 a month into an account. Kim does this for 5 years. If Kim's cost of capital is 6%, compounded monthly, how much does So Kim deposits $100 per month into an account for 5 years. Kim's cost of capital is 6% compounded monthly. How much does Kim have at the end of 5 years, assuming the deposit is at the beginning of the month? What are we looking for here?
Total at the end.
We're looking for the total at the end, which according to finance speak is what? Future value. So how would you go about setting this up? Actually, why don't you go ahead and set it up? I'll set it up as well, and then we'll compare notes. You are? Okay. Yeah, I'm not sure if you're still in the class because you weren't here last week. So you need to check with Renee down in the office. Is there anybody still down there? Okay. You may want to just run down and check now and see if they're there. Because I don't have you on my roster today. Because you weren't here last week, so they may have dropped you out of the class you weren't here last week. So check with Renee, but otherwise we'll try and get you up to speed as fast as we can. No, you can leave it here. Yeah. I just want to make sure you can try and grab them. Otherwise we'll have you sit through it and figure it out.
Yeah.
So you come. Yes, sir. Yep.
This is going on.
Yep.
So what would be, just be correct, then we should just do that.
Now you actually have nothing. You have nothing at the he's gonna be zero.
And the rate's correct.
Yep.
I wasn't sure what equation we should be using for that one. That's the ratio, the compounded ratio, right?
It's the future value in
Yeah.
Excel.
Okay. So, right?
Yep.
And then, do we just plug that in and then put the ones that are active rate, which is, right?
Divided by 12. Because it's 6% annually. It's compounded monthly.
Like that.
Yep.
And then I do it.
Then you do a comma.
I would do the 700 then.
It's probably your.
So would that be the 5?
So let's start with another parentheses there.
Right there.
Yep. So you're copying that, so that's your rate,
Okay.
comma, number of periods, so that's 5 years, so how many periods is that? That's compounded monthly, yep. And then, comma, payment,
700?
100.
Oh, is that a 1?
Yeah,
Okay.
I bet. Comma,
And then in the brackets.
and then there's 0 for a present value. You don't need to put the bracket.
You don't need to? Okay.
That's basically saying that the brackets say that it's optional. So if it's bracketed and you don't put something in there, it'll calculate. It'll default to zeros. And the type, in this particular case, the type is going to be a 1, which means that the deposit was made at the beginning of the period. If it's a 0, that means the deposit was made at the end of the period. So you lose 1 compounding. So it says that little brackets.
So 1's at the beginning and then you said 0's at the end?
Yep.
Okay.
So if you hit,
That was good.
yep. How are you? You got it? Let's take a look at that formula. The future value. Okay, so that is my handwriting. Where's that? I wrote 700.
Oh, is that 100?
You're supposed to be 100. No, my bad. I wrote it. If it's 700, yeah, it's 100. It's just my dollar sign Made it look like 700. So what you've got is a, let's go back to your formula. Future value, and if you, the easiest way to do it is pull down that, don't need any, get rid of it, don't need all those you got there. So you pull that down. Then the rate is going to be what? Divided by 12, right? So this kind of how it's monthly. Okay. So 6%. So you want to put the percent sign in? Where it's 0. There you go. Number of periods. 5 years, but it's compounded monthly, so 60. And the payment amount is, present value is 0, because you didn't have a beginning balance, and the type is going to be a 1, because the beginning is 2. Wow. Okay. Yep. The 6% is where your mistake is. The 6% annual percentage rate compounded out 3.1. So what you're going to do is you're going to take 6% and divide by 12. It's 0.5% per month. The compounding, and this is where it's a common trip, because it'll throw up these annual percentage rates. It'll say compounded quarterly, compounded monthly, compounded semi-annually. You got to divide it by the number of compounding periods. So this is where you went.
I would say just to sale, to shop.
Okay. 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 We'll get you squared away then.
Thank you.
It's compounded monthly. So that's going to be 6% divided by 12. Not quite. So get back to your formula there. Take that, so that should be 6%. And then we'll do the math right in there. So now 6% divided by 12. Yep, right in there. It's a slash. 12. And hit. Okay. Oh yeah. So that's the right answer. So let me I'll walk everybody through the process so that you've got everybody got there. And everybody had a couple mistakes in the formula. So we talked through those. We'll talk through them again. So here's the answer. And it's easiest to remember when we talked last week to try and set these up as little tables. Because then if you want to make changes, it feeds right into your model. So we had a payment of $100 for 60 periods, which is 5 years, and there's 12 months in a year, so it's 12 times 5, 60 periods. The rate per period was 0.5%. So where these things tend to trip us up, I guess I'll put the screen back up. Where these things tend to trip us up is when we look at things like it's $100 a month that goes here into an account. Kid does it for 5 years, so that's 5. The cost of capital is 6% compounded monthly. So as soon as you see compounded monthly or compounded quarterly or compounded semi-annually, you know that you've got 2 things you need to think about. You need to think about the number of periods, and you need to think about the interest rate, because normally those are defaulting in Excel to an annual percentage rate and to once a year. So if you've got, be on the lookout in any problem for compounding and frequency. So this says compounded monthly. So we go, okay, compounded monthly. So we know it's 12 months of the year, 3 to 6%. So 6% divided by 12 a month. 5 years times 12 is 60 periods. And so we go, okay, that's what that is. Then we go, how much does Kim have in 5 years, assuming the deposit is at the beginning of the month? So we go to our handy dandy Excel formula. And if you link it the way I showed you last week, what you're going to find is it says, okay, the rate is D4, the number of periods is D3, the payment is D2, the beginning balance, the present value. So when you see present value here, that's the beginning balance. So if it said Tim started with a $500 gift and then deposited $100 a month, you put 500 in as the present value. In this case, there is no present value, so we put in 0. And then that 1 at the end, you got a 1-0 choice. If it's at the beginning of the month, which is what the problem says, you go, okay, I put a 1. If it's at the end of the month, you put a 0. And you can put this as a separate line here, beginning of month or end of month, and then 1 or 0. And it'll spit out the future value, which in this particular case is $7,011.89. If you wanted to see what the difference was, if you made this an annual, so you made a $1,200 payment 5 times at 6%, changes it a little bit. It's actually a little bit higher. Why do you think it's higher? If I say it's compounded once a year, it's $1,200 one-time deposit each year. Why do you think, based upon this math, it's higher?
Oh, because the bigger amount is the 1,200 is the interest is applied towards 1,200.
Perfect. The interest is applied to the 1,200, and it's at the beginning of the period. And so the 1,200 went in month 1, where before it was 100 in month 1, 100 month 2, 100 month 3, 100 month 4. So if you change this formula to where it's at the end of the period, you make this 0. You can see it changes it by a little bit, drops it down under 7,000. So you lose 1 month's worth of compound interest. So this is a pretty typical future value problem, where you've got, with the exception of not having a present value, not having a starting balance in a bank account, Tim's just dropping $100 in there every month, and for 5 years at 6%, which is a pretty good savings account rate right now, by the way. And he or she has around $7,011 at the end of the 5-year period. So that's a typical future value problem. Let's take a look at a present value problem. So let's assume that Alice is expecting to get gifts from her parents. Those gifts are going to be paid at the end of year 1, end of year 2, and end of year 3. And at the end of each of those years, Alice is going to get $400. And then at the end of the first year, at the end of the second year, she's going to get $300. At the end of the third year, she's going to get $200. And Alice's cost of capital is equal to 5% annually. What's the present value? Or what would this, if this was a bond or a loan, what would this bond or loan trade for? So we've got a present value problem. Uneven cash flow present value problem. So Alice receives gifts. She gets $400 at the end of the first year, $300 at the end of the second year, $200 at the end of the third year. So it's uneven cash flows, one set in each year. They're paid at the end of the year. Alice's cost of capital, so what she could get on her investments, is 5% annually. What is a present value? And what you might have seen in the reading, and what you're going to see, is if this was a bond, or if this was a loan, and these were the payments that were coming in, what is the market value or the present value, because the two are going to be equal on that particular set of cash flows. So at what point, stated otherwise, at what point would Alice not care that she got 400, 300, 200, or she got a lump sum payment at the beginning of year 1? So this is a present value problem. Anytime you see there's future cash flows and how much is it worth today, that immediately should trigger present value. So I get in there and build a little table, and then run this through the present value formula. I'm going to do it on my machine here, and then I'll walk around and we'll talk about it. Okay, there's two ways to approach the solve. You could use either a nested set of PVs or you could use net present value, NPV, as a function.
You're looking at me for some reason.
But you looked up and I was like, okay.
So, oh, okay, I see that, that's fine.
The net present value, I'll talk a little bit about net present value because it's an important concept and it's the one that you're going to use most frequently in a course. Net present value essentially assumes it factors in the cost of money over time. It essentially says, okay, one where you've got straight present value assumes that it's being reinvested at the internal rate of return. Net present value essentially looks at your payout in the first period and says, okay, this is being reinvested at essentially the net present value minus any output. From a book perspective, they treat it the same. From Excel's perspective, it doesn't work the same. Net present value is generally going to be your easiest solution to solving, from a formula perspective, to solving the bulk of these problems. So let me walk you through net present value and see how you came out relative to the book answer. Come on, baby. So we talk about building this little box. And again, I know that it's easy to go, I just want to shortcut into the formula. But when you're making a mistake, or if you make a mistake, or if you're having trouble figuring stuff out or keeping things sorted, it's far easier to build a little box. And so the little box in here is you got a year 1 of 400, a year 2 of 200, a year 3 of 2, or year 2 of 300, a year 3 of 200. You've got a 5% rate, 400, 300, 200, a 5% rate annually, and it's over 3 periods. So you go, okay, there's no compounded quarterly, compounded annual, or compounded semi-annually, compounded monthly, so we're on an annual compounding. So that keeps things easy. And then you got the payment timing. 0 is at the end of the period, 1 is at the beginning of the period. So this said it's going to be at the end of each of the periods, so it's going to be 0. So if you look at the present value formula in Excel, you have to nest it. You basically have to build a present value formula for each one of those payments. So if you look at the present value and you go, okay, what's the present value of this first payment? Well, it's the rate. It's 1 period because it's at the end of year 1. It's 0 payments. Its present value or future value, excuse me, is the D2 is 400, and then C5 is your payment timing. So essentially, this says, okay, I'm getting paid $400 future value in this particular formula at the end of period 1. Then rinse and repeat for year 2 and year 3. You can see the payment amount is 0. The future value amount is the amount that's being paid. That's the 200, the 300 in each one of those. And then we've got the timing amount. However, there's an easier way to solve this. And it's to not use the present value formula, it's to use the net present value formula. And let me show you how much easier it is. The net present value formula essentially says, you get the same answer. The net present value formula essentially says, give me the rate and give me the cash flow stream, and I'll calculate back the net present value. And I'm going to assume, in this particular case, that there's no future value and that the payment timing is going to be at the end of the period, so you don't see a comma, 0. This is much easier than building that nested EV statement. Start seeing present value and present value questions, particularly when you've got uneven cash flows, and it's asking for net present value. Go ahead and spin up this NPV formula because it's a heck of a lot easier. All you got to do is highlight it's as easy as going equal NPV, rate, values. Nope, because in this particular case, it's compounded annually. And we didn't, if I say compounded monthly, you're absolutely right. You'd have to divide by 12 and you have to multiply the number of periods by 12. And so just for kicks, if we said, okay, this is gonna be compounded monthly, we take this and divide it by 12. It's not all that helpful in that format. And we take this and do what with it? Multiply by 12. And you can see that the net present value goes up a little bit. Why do you think it goes up a little bit? Yeah, you've got additional compounding, which is driving additional compounding periods, which is going to drive that. Actually, let me take that back. You actually can't do it. So I once again jump through my formula. It'll work on the present value side. It won't work on this. What you've got is essentially a rate that went down. So when I push forward 0.417, the net present value went up because it's being discounted at a lower rate. In order for it to be over 36 periods, we'd actually have to divide the 400 by 12, and it's easy enough to do. So if you didn't know how to do this in Excel, you can start a series of numbers and then just drag this out. And it'll automatically it'll automatically run it sequenced for you. And if you go, okay, I want 400 divided by 12, so it's 33 for the first 12 months. And then it's equals 300 divided by 12 for the next 12 months. And then it's 200 divided by 12 for the next 12 months. And the rate is 0.417. And what you're going to do is get rid of this formula because I'm not building that over again. This net present value formula, all you're going to do is take the rate, and this is going to go to change just a little bit because it compounds more frequently. Yes, sir.
We only have to use Excel.
You can use whatever you'd like, but Excel is by far and away the tool that will be most used in the real world. And so in this class, the way I approach it is all the tests and everything are open book, open notes, open Excel, open internet, open everything. And I would encourage all of you to get familiar enough with Excel to be dangerous, because this is what you're going to use when you get out of school. It's probably what you're using if you're in the real world now. And getting comfortable with memorization of formulas does nothing for me and does nothing for you, certainly. So this is the approach that I would like to use is Excel. So you can see that there's a little bit of a difference in net present value because you now have this more frequent compounding. So it's at the end of every month. Any questions on how to do a net present value formula?
What's the biggest indicator?
No, that's a great question, though. The biggest indicator is going to be a call to the question. So basically, the question is going to ask, what's the value of a set of cash flows today? It sometimes will say present value. What's the present value of? And that's a dead giveaway. Present value. Okay, NPV, build it. Sometimes it's going to say, what's the current value today of a stream of cash flows? What's the current value of a bond, which has a set of cash flows that is interest, 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 and then a principal repayment at the end? If it tells you if it's looking for anything today, what's the value today, that is a strong indicator that you're looking at a net present value problem. And if it's saying how much will be in an account at X time from now, tends to be a strong indicator you're looking at a future value problem.
How do we know when to not do the net versus just the present value? Is that when there's multiple?
For the most part,
Just use the net?
yeah, I was about to say, yeah, for the most part, you can get away with net present value, and it's gonna give you the right answer. Certainly, when it comes to anything in this course, you're going to be able to use either one of them, and it's going to be able to give you, as I kind of showed you earlier, it gives you the same answer. It's just one's this big nested mess, and the other one is a much simpler formula. Present value, straight present value, tends to be easier when you don't have uneven cash flows. You've got, okay, it's coming in 200, 200, 200, 200, 200, and it goes out for a bazillion periods. Why is that easier? Because as you see with net present value, you got to build the table, and you got to stretch this thing out over, in this case, 36 periods. If this was something where they said, it's an even payment amount of $340 a month for 360 months for 30 years, you're not going to want to drag this thing all the way out. So if it's an even payment amount and it's over a long period of time, that present value formula will give it to you just like that, because you don't have uneven cash flows. But you'll get essentially the same answer. What other questions on the Excel stuff? Yes, sir. Great question. So I'll show you two spots. The first spot is when you go in this particular version of Excel, and most of them have it, you're going to find that it's got formula sections here under formulas. Most of the formulas that we're going to use are going to be under the financial section, so financial tab or financial pull-down menu. And the ones that you're going to see us use are going to be relatively few and far between. You're going to see us use future value. You're going to see us use IRR. You're going to see us use NPV. You might see us use number of periods, payment, present value, rate. And if you hover over each one of these, it'll tell you, here's what it measures. So the rate returns the interest rate per period of a loan or an investment. For example, use 6% divided by 4 for quarterly payments of 6% APR. Almost every trip up that you can have in finance, Excel gives you the instruction, not only the instructions to okay, here's how to use the formula, but it actually tells you what the formula does and common mistakes that you can make when you're setting up the formula. So if you use Excel and you get comfortable with it, you'll get to know which ones of these formulas to use. Generally, we've started with time value of money. So generally, we're looking at net present value, future value are going to be the two main formulas that we're going to use now. The other spot to look is over in Moodle. When you look at our Moodle class or Moodle for this class, you'll see that I've got a couple things that can help. The first piece is you've got the classes from last year. So last year, this was taught more traditionally in that we sat down and we were here twice a week and we were here for hours and hours and hours. And it's still a fire hose of material, but we had twice as many class periods. So I've loaded up all of last year's videos so you can watch them. The other part for Excel, though, is you'll see here that Highline Community College has a number of Excel videos. So how to do, and you can see they build the little boxes as well, but how to do payment function, how to use rate function, cumulative payments, net number of periods, future value, payment, net present value, and you can find a bunch of other ones out online. And I also have, I think it's in this PowerPoint. If you go to this PowerPoint, you'll see that I've got linked some Excel tutorials, free Excel tutorials as well. So you can dive in. But if you get nothing else out of this class, then these three things. Time has a money value, money has a time value. So money today is worth more than money tomorrow. And if you're going to delay payment, you should get compensated for it. The second thing you should learn in this class is how to use Excel at least proficiently enough to calculate your car payment, build an amortization table, and kind of figure out, should I do X or should I do Y with capital budgeting? And the third thing that you should be able to figure out is going, okay, I understand the concept of this time has a money value, money has a time value, and I can understand how risk plays into the interest rate that I should charge. So why high interest rates equate to high risk and how to calculate that. So what the risk-free rate is, what the risk premium is, and really when you see a change in interest rate, if interest rates go up, what's that going to do to the value of your stock, or what's that going to do to the value of your bond? If you could walk out of here with those three concepts and you're pretty comfortable, you've had a successful class. If you can walk out of here proficient in Excel, that's going to be valuable for a lifetime. Some of the other stuff you might forget, like, okay, which formula do I use? Present value, future value. You know, can I figure out the value of a bond or a zero coupon bond at 8% that matures in 7 years? We're going to learn how to do that. But if you don't remember how to do that when you leave the class, unless you're in financial analysis, it's probably not going to kill you. But if you know how to use Excel and you can kind of muddle your way through to figure it out, and you kind of think through the concepts, you'll be in good shape. So these tutorials are ones that are worth kind of diving into and taking a look at and going, okay, here's how to use Excel and it's free. Functions and formulas, macros, VBA. So there's a lot of tools at your disposal. The way the class lays out, we've got these quizzes. You can take them as many times as you want. It doesn't make them easy. They're time consuming, they're a pain in the tail, and there's a lot of work to go into them. Don't save them to the last day because you're going to end up staying up all night trying to get it done. Just kind of chunk away at it. You take them as many times as you want, though. And what I would do if I were sitting in your guys' shoes is I would come here to class, look at what happened last week, and we dive into some questions. Then I would take next class, which would normally be on Wednesday, and I would do the quiz for those 3 hours. I would basically go, okay, I'm going to pretend like I'm in class. I'm going to knock that quiz out for 3 hours. I'm going to do the reading on Tuesday night. The reading is only normally about 20 to 30 pages, so it's not a ton of reading. Then, or maybe 40 pages. Then I'm going to knock out the quiz. I'll use the book it's the sound of freedom right there. And so then you go kind of knock out the quiz, figure out where you're not comfortable on the quiz, take the quiz a second time, and then come into class with your questions, and then rinse and repeat for the next 6 weeks. That's how I'd approach the class. I realize it's a fire hose and it's painful, but that's likely to be the most successful way to kind of manage your time. And so getting to know Excel is important. Getting through the quizzes and just kind of block and tackle through the course is going to be pretty critical. And those quizzes, like I said, you can take them over and over and over again, but sitting down and taking them is going to take, an hour to an hour and a half to just knock out each quiz. And so it's like, okay, if I'm going to take it 4 times, that's a lot of sit and guess an A, B, C, D. What other questions on chapters 1 through 4? What other issues did you get? Yes, ma'am.
Okay, so I'm like thinking towards the final.
Okay.
And the biggest things to take away from 1, 2, 3, 4 are future value, present value. Do we need to be concerned with
Ratio analysis.
Right.
Yep.
But do we also need to be concerned with the SEC and GAAP and balance sheet and things
Nope.
like that? Okay.
You'll need that for the midterm.
Okay.
You'll need that for the quiz
Right.
but that's it. Final? No, I'm not going to ask you. The only thing you'll need to.
Chapter 4 was the most relevant to.
Yes. And that's what I would, if you were in my 16-week class, I basically, and I think if not, I'll get you access to the 16-week chapters or the 16-week syllabus. Chapter 4 is the first thing that I call, and I'll pull it up so we can take a look at it since I got Moodle open anyway. Chapter 4 is one of the areas that I call critical concept. I'll give you a little bit of insight into some critical concepts because that might help you focus your time, energy, and effort as you're studying this stuff. That's a great question. Oh, good God, that's not an easy way to find it. So let me pull up main campus. So like you, Lacey has a similar structure. Unlike you, they have 16 weeks to try and absorb this, 3 classes a week. So y'all are like, this is brave. So the first critical concept you could see is in week down.
The first critical concept that they run into is time value money chapter. So while ratio analysis is pretty important, it's also not that horribly difficult from a math perspective. And most folks go, okay, I can do the mechanics. The interpretation of it is harder, but we dig into interpretation a little bit later in the course. So the first one that you're going to hit is chapter 4. So you're absolutely right in that when you're hitting chapter 4, that's a key concept. The next one is chapter 5, which is essentially looking at the cost of money and risk. That's your interest rates, essentially. Your next critical concept is 8, which is risk and return, how those two interact. Then chapter 9, which is capital budgeting. So essentially what capital budgeting is you say, okay, I have a choice between project A and project B. Which one do I choose? Or I have a choice, project A or do nothing. Do I do nothing or do I take project A? And so it's really taking anything that you can do in your business, trying to reduce it to numbers, assigning risk to it, and going, do I do it or not? Or which choice do I make? So that's a critical concept in chapter 9. The next critical concept is chapter 11, which is cost of capital, which is really starting to take all these concepts and put them into the firm and go, okay, how does this impact the risk profile of the company? If you understand those chapters, so 11, 9, 8, 5, and 4, you'll do perfectly fine on the final. I mean, that's at the end of the day, and the final stuff, I talked about that last time. If you can get those critical concepts down, that's going to get you 80% of the way there. If you're good at
The other thing that will help you a lot on the final, if you're, I just got to get through this dang course. The other part that will do you well on a final, I think they've got the same set. I think I left in the same set of extra credits. Your final is going to look very similar to extra credit number 1. It's going to have more questions to it. But extra credit number 1 is essentially about a quarter to a third of the final exam. Take a look at this company and give me kind of your story, your picture as to what's going on. Calculate this ratio, calculate this present value, calculate this cost of capital. And so if you can get through, if you're going, okay, how do I best prepare for the final? One of the best ways you can prepare for the final is the week before the final, do an extra credit number 1 on the company that I assign for the final. Because I will give you, in probably week 5, I will give you, or 6, so about 4 weeks from now, you're going to get and here's the link to the company's annual report that's going to be on a final exam, so you can start getting comfortable with it. You could read it, you can figure out where all the pieces and parts are. If you then use that information to do a financial analysis on the publicly traded company, which this is going to be, as your extra credit assignment, you'll have essentially block and tackled your way through probably a third of the final exam prior to the final and be familiar with the financial statements. And you're going to get extra credit on the final. So if it was me and I weren't fully comfortable going into the final, that would be one of my tactics. Is I go, oh, you gave me a publicly traded company and said that's going to be the final exam. Get familiar with it. Well, I do this extra credit. That's going to force me to get familiar with it. I'm going to get extra credit. I'm going to probably calculate it about a third of what's going to be on the final exam anyway. And then you get into the final and you're like, okay, because of course the final is open book, open notes, open internet, open everything else. If you've done this work already, you can reference it. It's not a lay down, but it's because it's still a lot of work, but it's a way to get yourself a head start. At the end of the day, like I said, our goal isn't to get you to gotchas. It's to actually get you to where you're getting comfortable working with this material. What other questions? Probably a little bit. We'll go into a break, but before we go into break, I want to give a little bit of chapter 2. I actually want to give some ratio analysis because that to me is also not only helpful for the final, and I know sometimes we're grade motivated, but it's also kind of useful for real life. Any other questions? Yes, sir. No worries. Sure. You can do both. Yeah, you can do them both. The biggest key to passing this class is doing the quizzes. Knock them out. And I mean, they're painful. I recognize they're painful. This is like a math class. And so you go through those quizzes, that's going to get you the grades, and you can keep retaking them. You could retake them up to the deadline. Yes, sir.
More than one quiz? Yeah. Or chapter 1 to 4?
No. There's just the one, but you can retake it.
Okay. I thought you just had it.
What other questions? It is. And I told you the first night, I'm like, you guys are brave because this is a hard flipping class and you guys are trying to do it in essentially 6 weeks. I don't know how the heck you do it, but you'll do it. Let's talk about ratio analysis. Oh, that's not what I wanted. I want that. Ratio analysis is a pretty important concept. It's important enough that it's something you can use all the time after you get done with this class. And I use it routinely to try and give myself a picture of what's going on with the company. And like I said, I've been doing this for 25 years, and so it looks to me like it's that John Nash beautiful mind thing. It starts popping in, pictures, just lights up, and I'm like, okay, I got a picture of what this company's doing. I'm going to walk you through a little bit of how that operates and let you kind of pull out a few ratios and do some basic analysis. We're going to break, at the normal break time, about quarter of or so. So we'll dig into this for about 25 minutes. Then we'll break. Then I'll get into some of the 5 through 8 stuff. Unless you're like, okay, I want to dig more into ratios. So ratios essentially take a company and do what we call common size it. You could compare a big company and a small company if you reduce it all to ratios or percentages. Percentages are ratios. And so if you look at, and the book uses this absolutely abysmally performing company called Unilite. And you can see this is essentially ratio analysis. I'll give you a basic ratio analysis, not quick ratio and current ratio. But this is conceptual as ratio analysis. You can see what's changing, if anything. So you can say, okay, my margins aren't changing. So this is a ratio as a percent of sales. You can see that EBITDA is going down as a percent of sales, so that's a ratio. You can look at year over year and go, okay, what's going up, what's going down, and you can compare it easier than going, okay, I'm going to compare 130 to 133. Is that a big difference or a small difference? Well, it's a decline based upon a percent of total sales. So this is all ratios on percent of total sales. It common sizes the income statement, or it common sizes balance sheets. Ratios are an indicator of the future health of the firm. In finance, we don't care what happened in the past, except to the extent it impacts what's going to happen in the future. Accountants look at the past. Financial people look at the future. You take the two, you put them together, and you get the full picture of this is how the company's come to where it's at, and this is where it's going. And so really what we're looking for is in financial analysis, ratio analysis is financial analysis. We'll do basic financial analysis here in the next 20 minutes, and you're going to be like, okay, this isn't horribly hard. We can make it sound hard. We can make it look like rocket science. It isn't. You guys are going to be able to do basic ratio analysis, financial analysis coming out of tonight. You probably did it on the quiz. We're looking for trends and anomalies. We're looking for weaknesses and strengths. It allows us to compare, and it's focused on the future. We're trying to interpret what we think is going to happen, not what's already happened, even though we're looking at historical data. There's 5 kinds of ratios. There's liquidity ratios, can they make their payments? There's asset management ratios, which is if I gave a company money, if I invested in a company, are they using that money wisely? Are they getting a good return on it? There's debt management. Can they pay their bills as it pertains to debt? Can they handle more debt, or do they need more equity? There's profitability ratios, which are how do the operations and the financial structure impact the profitability of the company? And then there's the market value. So, and we're not going to dig into, although it's in chapter 3, all the market hypotheses and efficient markets and strong form, weak form, semi-strong form, interesting stuff. It's all in the book. But the market value essentially says, look, we're finance folks. We care about the future. The market price of a stock is nothing more than a combined estimate by the entire universe of investors as to what they think the expected future cash flows for that stock are. That's all it is. It's a consensus estimate of the present future cash flows of that stock. The price of a bond is a consensus estimate in the market of what the expected future cash flows of that bond are. The price of any asset in finance is a consensus estimate, if it's a market. The consensus estimate of what the expected future value of the cash flows are. That's finance. So if you've got a market and it's a reasonably efficient market, like the stock market is reasonably efficient, even under weak form, it's reasonably efficient. This value, the expected future, is the expected present value, the expected future cash flows of that security. So that's what you're getting in market value. So that's an important measure because you've got hundreds or millions of people looking at that stock trying to predict what the expected value of that stock's going to be and how much cash you're going to get out of it. And that's how it's priced. So that's a consensus estimate. Let's look at a couple ratios. Unilite's current ratio. That's current assets over current liabilities. We talked through that and kind of how you can window dress this a little bit at the beginning of class. In this particular case, I've got 465 million in current assets, 130 in current liabilities. So it's 3.6 times. Is that good or bad? It's good. Is that good or bad? Who wants to say it's bad? It's bad.
Because it's less than the industry average, right?
Good. Here's the important part to understand with ratio analysis. A ratio in and of itself is difficult to interpret. You normally need to interpret a ratio against a benchmark. In this particular case, the benchmark that's going to be used is industry average. So we go, okay, there's a bunch of other textile companies like Unilite. So we're going to look at the industry average. We're going to take all those companies, we're going to go, the industry average is 4.1 times, Unilite's at 3.6. So it's a little worse than the industry average. Is it catastrophically worse? Well, I don't know. We can look at some more data, but it's not as good. So it suggests it's not as liquid as the average firm in its industry. You're going to find the book uses suggests, and I put it in italics. Sometimes it doesn't suggest, it is. Then we'll see an example of that. But normally it suggests something because you're really taking a little snapshot. This is a snapshot of their current ratio. This is a snapshot of their current assets, current liabilities, ability to make a payment. You saw in the question that we had at the beginning, you can make this, you can window dress this thing, and you can really actually screw up their ability to make a payment by wiping out their cash and paying down the debt. But it's going to make the current assets and current liability, it's going to make this current ratio look better. And then make their quick ratio look worse. So what you need to, and we'll talk quick ratio in a minute. So what you need to look at when we're talking about ratios is it's just a snapshot. It's one little piece of the picture. Stick it on the wall. So we go, okay, this looks like a little worse. We're going to stick that in the back of our mind. We're going to stick that on the wall and go, yeah, it looks a little worse. Now let's look at the quick ratio. We take current assets minus inventories over current liabilities. This is getting us closer to what do I expect that I'll have in 30 days. Inventory might not turn in 30 days, but accounts receivables should turn in 30 days, cash should turn in 30 days over current liabilities. So this now, Unilite is at 1.5 times. The industry average is 2.1 times. Is this good or bad? It's bad. Why is it bad? Yeah, it's getting where before they were relative, they were close. Now the spread is starting to get bigger as you're getting closer to cash. So now you're going, okay, this is a problem. And what does it tell you? It tells you a couple things. And remember the first class where I said finance is a story? You got to start thinking about stories. You got to, and that's going to be an important skill. So this says at the bottom, Unilite's ratio is below the industry average, which suggests lower than average liquidity might be the result of a large amount of inventory. You should take inventory out, and all of a sudden what was really close now becomes a bigger spread. Because so they're low on accounts receivable, low on cash, high on inventory. Why do you think they might be high on inventory?
Well, it depends on the industry. Maybe they were like a toy company preparing for the holiday season or something. They could have bulked up on inventory.
So you could see seasonality. So maybe, now this is industry average, so it should be the seasonality might be the same for everybody, but it might be Unilite's a textile company and it makes fleece. And there's going to be a spike at the measurement point where other folks are in cotton, and so they're going to be down. So that's actually a very sophisticated answer to
to a very straightforward question, because most people don't ever see the seasonality and don't bring it up. But that's critical, especially if you've got a company that tends to be specialized, where you're going to see things like a spike around a holiday or around a season, or weather season. What else? What else might be, because why else might they have a lot of inventory?
They can't move it.
Why aren't they selling it?
I guess there's many reasons why they don't have a good business plan, maybe they don't have good sales.
Those are both good reasons. What else?
They might be borrowing more, but into their liabilities being more than what they can sell.
So maybe not only is their inventory high, but their liabilities are high too, because they're borrowing to cover off something. Yes, ma'am.
I thought maybe like a deal could have fallen through, like they could have had inventory, and prepared to make a sale, a large sale, and then it fell through at the last minute.
So take all those little stories. Anybody else have any other theories, hypothesis? Take those, set them against the wall. Let's take a look at a couple more ratios. This is, liquidity position is fairly poor. Now we've got asset management ratios, inventory turnover, days sales outstanding, how quickly they collect their accounts receivable, fixed asset turnover, how efficiently they're using their property, plant, and equipment, and total asset turnover, how well they're managing all the investment money that people have given them. So let's look at inventory turnover. They turn over their inventory 4.6 times a year. The industry average is what? 7.4. So what is it? Now, this is one where it goes, it suggests it might be holding excess inventory compared to the average from the industry. There ain't no suggestion. I mean, this is almost double now. So it is holding excess inventory compared to the average from the industry. Does the story change? Is the story coming further into focus? So we got an inventory problem. We know we've got an inventory problem. It might be seasonality, but it might be crappy product or crappy salespeople or a market that doesn't exist or a new product line that's not selling. But we got an inventory problem, and that inventory problem is starting to mess up our cash flow. So let's look at another ratio. Day sales outstanding.
Day sales outstanding is how quickly they get paid on their accounts receivable. So in this particular case, the average time it takes for them to get paid is 43.2 days. The industry average is 32.1 days. Take that, and what does that tell you?
Taking an extra 11 days for their inventory.
Taking 11 days to get paid by whoever they sold their inventory to. So what does that tell you?
They're doing a lot of IOUs.
They're taking a lot of IOUs, for sure. Dig a little deeper. Give me a little more story.
Honestly, I think it's a part of their business plan. They don't have a strong business plan as far as getting product sold, and then getting money for the product. I mean,
You're absolutely on the right track.
Like the product is taking a long time getting to the customer.
Maybe, maybe not. Yes, ma'am.
The account manager and the sales team should all be working together to coordinate the sale at the same time. So you should be receiving your funds at the same time that you're processing the sale.
I'll buy that. Anybody have anything else? And I'll give you my hypothesis. Here's what I'm seeing. We got inventory that's not selling. We're sitting on piles of inventory. And we're a manufacturer. We do textile manufacturing. We sell to retailers who then sell to customers. The folks who actually bought our stuff can't sell the crap either, because they ain't paying us, so they're not able to get it offloaded to the customer. So they're sitting on inventory. Essentially, you think about it, we manufacture it, we then sell it to a retailer. The retailer then holds it in inventory, turns it to cash. When they get cash, they pay us a bill. They can't sell it. I think we got a business plan problem. I think we got a product problem in particular. I think we've got a product that nobody wants. So retailers ain't buying it from us, and we're manufacturing tons of it. And even when they do buy it, nobody's buying it from them. So it's slowed down their payments. So that's where I'm trying to build this collage around, okay, this is a product problem. Now, majors in this class, right? Oh, you're the finance. That's right. You're a finance major. You're a finance major too? Awesome. Now I got almost half the class. So
Your ratio's going up.
yeah, ratio analysis. So bear with me. Finance folks, bear with me. If I'm a marketing person or I'm a management person, I'm looking at this company going, how do I fix this problem? Because I'm going in there going, okay, look, this is all great numbers to me, but what it's telling me is they got a product problem, or it's telling me that their salespeople aren't doing their job, or it's telling, although maybe some salespeople aren't doing their job because these guys ain't getting money either, although it could be that they're making bad credit decisions to extend credit to these folks. They're not following up. The account managers aren't following up to make sure the bills are getting paid, make sure the deliveries are being done on time. But I'm looking at it, if I'm in marketing or management, I'm looking at this going, I got a problem. I think I got a product problem, I got a process problem with both. And I'm gonna have to start digging into this because it's not good enough to just do ratios and go, oh, you know, we suck. We really want to go, okay, why do we suck and how do I fix it? And that's where this becomes relevant to folks who aren't finance folks. If you're a finance person, you're looking at this generally going to be from the outside. Although sometimes from the inside, you're going to want to do the same analysis and feed to your management folks and feed to your marketing folks. I'm seeing a problem, let's talk about it. A lot of times you're going to be on the outside. You're going to be going, okay, I'm going to be extending credit to these folks. Do they have the ability to pay? Am I comfortable with this if I'm the banker and I've got to write them a loan? If I'm giving them trade credit to buy textiles from us that they're going to manufacture into some other textile product to then sell to a retailer? That's where the finance side comes in. Or your investment banker going, okay, these guys need to raise another $20 million. Is it going to be debt? Is it going to be equity? Is it going to be preferred stock? What's it going to look like? You're going to be looking at their cash flow going, okay, we got a problem. Yes, ma'am.
Is this an annual or is this a quarterly?
So this is an annual.
Okay, and then if we can quickly explain this past the numbers for 1 year, is it a big deal? Or is this like if we see it multiple years in a row, then it's a big deal?
So that's an awesome question. So here's it depends. But what you've now got is you're armed with the question to then ask management or to then bring to the table. Because it may be that what you've got here is we are launching a new product line. So we've ramped up production of a new product line. We've started the advertising piece, but you have to build the inventory before you can actually sell it. And so you're not going to advertise it until you have inventory to sell. So maybe that we decided to launch a new product line. That product line is either slow getting off the ground or we're just at the beginning cycles of it getting off the ground. And really, there's no problem at all. It's a one year blip as we entered this new product line and generated market demand and then started pumping it through the market. In which case, you see this as like a bunny through the python, and it's going to be one thing that's going to go flow through it and it's going to be fine. Or you might go, okay, we got a bigger problem here. But that's the perfect question to ask and to dig in because you're going to want to know. Because you're not going to want to have to wait another year if there's a problem. You can do it quarterly, and you can see if there's, especially if you think there might be seasonality, which was your hypothesis early, you're going to want to look at it quarter over quarter. And you might want to look at it in what you'll hear called longitudinally. Basically, you're going to want to look at year over year, quarter over quarter, fourth quarter over fourth quarter over fourth quarter over fourth quarter, and see if you're seeing any trends year over year. So yes, you're absolutely right. Fixed asset turnover. Fixed asset turnover is how efficiently they're using their property, plant, and equipment. So what do you think here?
I mean, it's bad, but not terrible.
Yeah, they're fine. They're fine. So probably their production process is working okay. They don't have a bunch of idle equipment lying around. There's things that can screw with these numbers, but let's take it at face value. They're probably as typical, they're typical for their size, they're typical for the industry and their efficiency of utilization of property, plant, and equipment.
So if I'm looking at this company, I'm not going, okay, I got a manufacturing problem. I think I got a product and marketing problem. I don't think I got a manufacturing problem. I might have a credit extension problem for the finance guys, but I don't have a manufacturing problem most likely. Total asset turnover. So this is sales over total assets. How quickly are you turning your assets into cash? How efficiently are you using all the assets, your inventory, your cash, your accounts receivable, your property, plant, equipment, all that stuff? How does this look? It's close. They're a little behind, but it's not catastrophic. So let's go back and now give us another picture. How is the picture coming into focus? What are you seeing?
We just go back to that one. I mean, you guys gave good examples of what it could be. So could you just ascertain what it is within that one ratio that's causing the big difference?
Probably is. So let's look at some debt ratios. Here's your debt. Total liabilities, which includes accounts receivable or accounts payable, over total assets. They're 15.9%. So when you think about it this way. The easiest way to think about it is of all the things they owe, not assets, they borrowed to buy 51% of them. And the other 49% is equity. The other 49% is invested cash, and they borrowed 51% of it. The industry average is 42%. So what does that tell you? Maybe, probably. Certainly tells you this. They may have borrowed to make some new investments, so now I can start to go, maybe we have to dig at the balance sheet, or maybe they've got this new product line and they borrowed some stuff to buy some new property, plant equipment. We'll have to look at that. Is this, do you think, a riskier or less risky company than its peers? Why? It has more liabilities over assets. It's got more leverage. It has less cash. It's got less ability to ride through a hiccup or a bump because it doesn't have reserves. And it's probably going to be tougher for it to borrow money because it's already got more debt than the industry average. So if you're the bankers, the finance guys in the room, and you're looking at this going, they want to borrow more money, you're going, wow, you're already like 25% more than the typical company in your industry, and you want to borrow more money? That's going to make me a little bit nervous, especially when I start looking at some of these other numbers.
But that would be dependent on if it was just this year, right?
Correct.
I mean, if you're going over the 5 or 10-year period, and just only this year, it's like that.
Could be, and you're going to want to ask why. If all of a sudden you're seeing an anomaly or a dip, you're going to want to ask why. Yes, ma'am.
Is that like one of the bigger components for the change in our tax plan, where giving cuts to corporations, then they have, in theory, more cash, right? More assets.
Correct.
Lower their debt ratio. So
That's
is that like an arguing point for that? I don't know.
It is.
Okay.
It's the other arguing point is our tax rate, our nominal tax rates were significantly higher than those in countries like Ireland or Luxembourg,
Right.
Which is where Apple and Amazon tended to hold a bunch of their intellectual property, their licensing. And so by dropping our tax rate to 21%, they can now bring the money back. And but generally, have you taken economics yet?
Yeah.
Okay, yeah. So basically what you're looking at is the difference between fiscal policy where we go, we're going to tax it, the government's going to spend it, versus we're going to lower taxes, we're going to have the private sector spend it, and which one's going to get more of a multiplier in the economy. But the general piece of the tax plan is, yes, if they're not paying it out in taxes, then they're going to reinvest it in something or pay it out in dividends. And so, because they're not going to hoard cash, which is not necessarily true, but that's the theory. And so then the question is, from the economist side, is lowering taxes and having them reinvest going to generate more economic value than having them pay taxes and having the government invest? That's the question. Yes, sir.
I'm just going to go back to the slide before. Does that make it, when you talk about riskier, as in
Yes. But we're going to talk more about it because so if you're the investor and it's riskier, what do you want? What do you expect because you're taking on more risk? Not necessarily. More return. So you go, hey, if the risk is high, that's fine. I just want a higher return. Critical concept. So I'm going to take on more risk. I want more return. If I'm taking on more risk and I got lower return, that's a crappy trade-off, and I don't want that. So I want more risk, more return. That's fine. So, and you'll see, we'll come back to Unilite over and over and over again. But you'll see how this works, and it's pretty nifty because it impacts the stock price. You see the stock price goes down, you go, well, why is the stock price going down? Well, because the discount rate on the expected future cash flow is going up. Well, why is the discount rate on the expected future cash flow is going up? Well, because there's more risk, and more risk means higher discount rate. And you'll see mathematically, you're starting to see with present value, for instance, higher discount rate means lower present value. And that means more risk, lower present value. It all kind of, this big picture of risk and return starts to come into focus. Times interest earned. This is their ability to actually make their debt payments. What's EBIT? Earnings before interest and taxes over interest charges. If you don't make your bank payments, it's going to be game over in relative short order. And so their EBIT, which is earnings before interest and taxes, because interest is tax deductible, is $130 million. They have interest expense of $40 million. It's 3.3 times. Industry average is double that. So what's this tell you? Not good. I mean, the more we're digging into this company, the crappier it is.
I was trying to roll with it, but then you get this one.
Yeah, no.
Yeah, it's below the industry average.
So far. Now, I will tell you, when we do this over the 16-week class, or we do this over the 8-week, twice a week, we go through this, what we're going through in like half an hour, we take a 3-hour block. And we really dive into these theories, because most folks are where you're at until you hit this slide. And they go, oh, it's not, it's okay. Holy crap. This is problematic. Now, this one is really a fun formula, because it looks far worse than it is. You got your earnings before interest and taxes plus lease payments. Why do I have these payments back in and available cash? Kind of, sort of. So lease payments are operating expenses, so they're out of the expenses. So what this is trying to do is go, okay, after we've operated the business, how much cash is available to make our debt payments? Well, our leases are part of our debt payments, because we don't pay the lease on our equipment, they repo the equipment. We don't pay the lease on our building, they evict us from the building. We don't pay the lease on our trucks, they repo the trucks. And so you got to make the lease payments. So not only do you have to pay your bank, but you got to pay the lease, otherwise you ain't going to have a factory. And so you go, okay, let's see how we're doing on fixed charge coverage. We're going to add the lease payments in here, we're going to subtract them back out as an expense here. So we're going to say, okay, we got interest charges we got to pay every month or every year. We got to pay the lease payments on our trucks, on our buildings, on our equipment. And then we got, what the heck is a sinking fund payment? Can anybody give me a very simple definition of what a sinking fund payment is?
It's sinking. It's lowering.
You're on the right track. Let me make it as simple as possible. It's a principal payments on the debt. A sinking fund essentially is a savings account. You go stick it in, and then eventually you use it to pay the principal off. But it's the principal payments on the debt. So if you think about that bottom line, it's the interest on the debt, the principal on the debt, and my lease payment. That's the bottom. The top is the cash available to pay. So in this case, Unilite has $130 million in EBIT plus 10 million in lease payments. They have $40 million in interest charges, 10 million in lease payments. And then why is this one over the tax rate for principal? Why does it gross up to 13.3 million? I don't count this in here, do I? Okay. Principal is not tax deductible. So you can deduct this off your taxes. You can deduct this off your taxes. You can't deduct principal payments off your taxes. And so you actually need $13.3 million in pre-tax money and $8 million in post-tax money to make your principal payment. Is you're paying a 40% tax rate. So you want to ask why the tax rate is a big deal? Because if this was at 20%, which is where the tax rate has now been changed to, instead of needing 13.3 million to make your debt payments, you'd need 11.15 million or 11.25 million. So you actually save a bunch of money. The company is going to have a little bit more cash in its reserves. So in this particular case, fixed charge is at 2.2 times. Industry average is 5.8. Now we're almost a 3x, 3 times worse. This statement at the bottom is one of the understatements of the year. Unilite's fixed charge coverage ratio is well below the industry average, which suggests it's not as able to cover its fixed financing charges as the average from the industry. I don't know where the suggestion is because it's pretty much fact. It's having real challenges here. Debt position. Conclusion. Debt ratio is higher than industry averages. Coverage ratio is lower than industry averages. If I were a finance guy, I wouldn't loan him any money. If you loan him money, you're going to want what? More return, because you're doing what? You're taking more risk. You have that concept nailed down in this class, you've learned something important. That's like one of those 3 things I talked about. Now you got profitability. Profit margin. Net profit over sales. In this particular case here, 3.6%, industry average 4.9%. What's that tell you? Give me some more stories.
You're spending a lot on what you're trying to sell because your sales are actually pretty high, but your profit is really low.
Yeah, so let me spin you a yarn. Not only can't we sell the crappy inventory and crappy products, but probably to sell the ones that we sold, we've discounted. We probably dropped the price. We're not making the margin we should because people ain't going to pay full price for our stuff. So to get the stuff moving, we've had to discount the price, which is impacting our profit margin. So take that Post-it note, stick it on the wall, along with all these other Post-it notes we've put on the wall, and you start, again, getting this big, it's like a collage, and it starts painting this big picture of what Unilite is or isn't. Return on total assets, net income over total assets. 54 million of net income, 845 million of total assets, 6.4%. Industry average is 10.3%. That's bad. Go back to the asset ratios that we looked at 5 minutes ago. Where's most of this problem? The return on total assets is low. But why is it low? Is it low because they're not getting a good return on their property, plant, equipment? It's low because they're not getting a good return on what? Well, net income isn't high enough, but we looked at that in terms of sales before, and we're going to see this new power ratio, which is a hellish thing that will help us identify this stuff. But what else is not? What assets are probably too high? Inventory and
accounts receivable, the other side. So people make payments, so their accounts receivable, they sales outstanding were high, inventory's high. We know that the property, plant, and equipment was pretty efficient. And so when you look at their return on total assets, probably where the mess up is, where the problem is inventory and they're getting 13% return on equity for the shareholders here. Industry average is 17.7%. So if I told you you had a choice to invest in a textile company, you're going to pick this one? No, you're going to pick one of these other ones. What happened to their stock price? It goes down because they want to make this up somewhere, so they're going to punish the stock price, drive the stock price down so that they can get that return and the stock price never goes up. Because the stock price is what? Yeah, it's a consensus of the expected future cash flow associated with that security. Profitability. Operating results have suffered because of poor liquidity position, poor asset management, poor debt position, and crappy products. Fired. PE ratio. Earnings per share. Their price to earnings ratio is 10.6 times. So for every $1 in earnings, you're paying $10.60 for the stock. The industry average is 15. So for every $10 or for every $1 in earnings, you're paying $15 a share in stock. Is this good or bad? Well, why? I'm paying a lot less for each $1 of earnings. Well, am I really? I mean, look, these earnings, these are we earned that last year. I'm making good money here. I mean, I'm getting these earnings at a discount relative to other companies.
But you just stated that the reason they're dropping the stock price is a bad reason. It's because they're not moving in front of it.
What's the fallacy here? What's the one piece that gives you a problem? What's this measurement?
You can get more from another industry, like as an investor, you're looking at it. I mean, I'd go with another industry.
It measures how well their products are, right? In the market.
What's the stock price a reflection of? What's the stock price?
It's for the
Earnings?
The stock price is the consensus estimate of the expected future cash flows associated with that stock. What earnings is it showing up here? Is that a future? That's past. You're looking at $2.16 a share for 2016. That was last year. That was 2 years ago. You're like, woo, I'm getting these earnings cheap. No, you're not. The expected future cash flow is all we care about in finance. This is an indicator that most companies in this industry, they expect to grow faster. They expect they're going to have more expected future cash flow in the future. Grading is getting worse because when we compare it to its earnings last year, we're saying future earnings are likely to continue to decline or get lower because the stock price is a reflection of the estimate of future cash flow. The earnings were a measure of last year's cash flow. So don't forget, finance looks forward. We use accounting measures, but we really look forward. Market to book. What's book value per share? What's the meaning of book value per share? In accounting terms, book value per share is you take all your assets minus your liabilities. That gives you what? Equity. So assets minus liabilities is equity. Take your total equity divided by the number of shares outstanding. That gives you book value per share. In this particular case,
for every $23 in assets, I'm only, or for every $16 in assets, I'm only paying $23 a share. Where if I was to buy the same company, if this was some other company, for every $16 in assets, I'm going to pay almost $40 a share. Isn't this a great bargain?
Buy low, sell high.
Yeah, if they rebound next year, then it's a great buy. But
What this is telling you is the market says the future prospects of this thing are worse than the rest of the industry. Another understatement of the year. It suggests that the investor value stock lower than other firms in the industry. No, there ain't no suggestion about it. They're valuing this stock like it's going into the toilet. They're looking at the future prospects for this company and going, this does not look good. As a matter of fact, once that book value and market price get to 1.0, in theory, and it's far more complicated, but in theory, you can liquidate the company, pay the whole value out in terms of a dividend to the shareholders, and it's going to be equal. Sometimes you find companies with book values below 1.0, the market to book ratio, in which case the company's prospects are so bad that they say they're going to lose more money than the assets are worth to just get rid of the assets. This is not good at all. Unless you know something that somebody else doesn't know, this is not a good sign. This means that folks are looking at this company going, man, this thing's dog crap, and we're not going to buy it. So with that, let's take a break. Let's take 10 minutes or so. We'll be back at 12 after, 13 after, somewhere there. I'll hit on chapter 5.
How late is this class on? 7:40? 7:50?
750.
7:50?
Yeah. There's just so much to cover.
There it is.
So for that other extra credit, that's how you do it, just how, like how you know, like textile.
Yep.
Okay.
Hello. Yes, sir. Yeah, because the registrar has dropped it, but I'll deal with that tomorrow morning. I'll get them squared away.
the cutoff for the quiz is midnight, or is it like 9?
Yeah, midnight essentially is when it shuts itself off.
you guys get over, so.
All right. Let's talk some interest rates. Heck yeah. This is the other critical concept piece. So we've talked a little bit about time value of money. We just went through a fire hose of ratio analysis. You kind of get the idea of how that storytelling works. Interest rates, it's cost of money. Well, what do you think we mean when we talk about cost of money? Interest rates equal what? It's a measure of what?
What your monthly fee for you.
Which is based on what? So what do you call payback in finance speak?
Return.
Return. And what is return? How do you figure out what your return should be? Risk.
I've answered that question 3 times.
I know. That's like looking at you. Like, it's risk.
Opportunity is always risk.
Risk. We're going to learn this thing called CAPM. Now, my one class heard this CAPM thing so many times they bought me a bug that says CAPM on it. So CAPM is a capital asset pricing model, and it basically is a calculation of risk, and it reduces risk to a formula. And we're going to learn all about it. It's Nobel Prize winning awesomeness. Interest rates are a reflection of risk and return. It's the return that you get on your money. You can see this is a history of interest rates from 1990 to 2014. Short-term interest rates, which tend to be driven by fiscal policy. The government tends to drive short-term rates. Long-term rates, which are 10 years or longer, tend to be kind of trend-driven. So you can see this is a very busy slide. What you'll see is in recessions, what happens to interest rates? Recessions are these blue strips. They go down. Why do you think interest rates go down in a recession?
No one's spending money.
Folks aren't spending money, and what's the government trying to get people to do? Spend money. And so if the government's trying to get people to spend money, and they don't have any money to spend, what's the best way to get money? You don't have any money and you need money, what are you going to do? You're going to borrow it. So the government goes, we're going to drop interest rates, short-term interest rates, to incentivize people to borrow money. The other thing that you'll notice is normally when you have a recession, you tend to see a drop in inflation, because inflation is being driven by demand, and it drives up price. So you see recession, inflation goes down. Recession, inflation goes down. Recession, inflation goes down. Long-term interest rates over time have continued to decline, but short-term interest rates are far more volatile. We talk about interest rates because it's the measure of risk. There's two pieces of calculation that you do for any interest rate. It's got two components. There's a risk-free rate of return, meaning generally, you know you're going to get repaid. You know you're going to get repaid on time. There's no counterparty risk. There's little inflation risk. There's hardly any risk at all. This is like a government treasury bill. And then there's the risk premium, which is basically going, okay, if I'm going to take out more risk than lending money to the government short term, I need to be compensated for it. So the return interest rate is going to be higher as my risk goes up. The risk-free rate stays the same. The risk premium goes up as your risk goes up. It's pretty common sense. There's a bunch of pieces associated with risk. The rate of return or interest rate is the sum of the risk-free rate, which is R sub RF, plus risk premium. The risk premium is broken out for the purposes of this class into three chunks. The default risk premium, which is what, do you think?
How likely are you to not pay off all?
Perfect. The chances that you're not going to get repaid. The liquidity premium, what do you think that is?
How
Not quite. Close.
How much cash would you return?
Your assets.
How liquid, how easy it is to get your money back. So if it's a bond that you can't, or a stock that doesn't trade on a stock exchange, the liquidity premium is going to be higher than if it's something that you can sell to anybody.
Is that a percentage or a number?
These are all going to end up being, they reduce the percentages. And then what do you think maturity risk is? The amount of time it's going to take for you to get your money back. So what you've got is, if I'm going to get my money back, how easy it is to get my money back, and when I'm going to get my money back. That's the three components. Essentially, what you end up with is a real rate of return does not include inflation. The nominal rate of return includes inflation. And we saw inflation kind of over time on that last graph. Inflation's been low for a long time. It could spike, and when it spikes, it gets factored into the risk-free rate. So what you end up with, if you've got a nominal interest rate, which is what we normally work in, the real world operates in nominal, you have four. You have maturity, which is how long it's going to take until I get paid back. Liquidity, how easy it is to get paid back. Default risk, how likely it is I'm ever going to get paid back. And inflation, the difference in value of $1 today versus $1 5 years from now, because those of us who are ancient can remember that when I was a kid, I could buy a brand new car for like $9,500. As a matter of fact, when I was a kid, you could buy a brand new Yugo for $39.95. Brand new anything for $39.95 now.
Maybe a moped.
Yeah, you wouldn't have wanted to buy a Yugo for $39.95, but I remember Yugos, and you could buy them for $4,000. The cheapest cars you're going to be able to buy now are going to be about $10,000, $11,000, and you're talking like Kia Rios. So, inflation has happened over time. And so the dollar today is worth a lot less than it was 25 years ago. So for short-term treasuries, you only have an inflation premium for short-term inflation. For long-term treasuries, you have an inflation premium for long-term inflation plus the maturity risk premium. For short-term corporate bonds, you have the short-term inflation premium, you have the default risk premium, and you have the liquidity premium, how easy is it to get back. For long-term corporates, you have all of those. Inflation, default risk, liquidity premium, and maturity risk. So you got all these different risk components going, you need to be compensated for it, and they turn into interest rates. So interest rates change over time. And this is how they changed over time. You can see that when the recession hit in 2008, which some of you could probably remember, interest rates, short-term interest rates went really low. Dropped by, within a year and a half, dropped from 5.2% to 0.9%, 5% to 2%, 4.5% to 3%. So what you saw is fiscal policy pushing short-term interest rates down to stimulate the economy, but long-term interest rates, while they went down, didn't go down nearly as much. 20 years out, they didn't go down nearly as much because over the long term, everything kind of reverts back to the mean. These are yield curves. You'll hear and see things called yield curves. This is a typical yield curve. Short-term interest rates are lower, long-term interest rates are higher. This is an inverted yield curve, which means short-term interest rates are higher than long-term interest rates. That's what happens when the government's trying to slow the economy down. They push short-term interest rates up. In the long haul, everything reverts to the mean. And you can see that as you go out 20 years, that spread narrows. As you're here in the 1 year, 2 year, 3 years, the economy at those various points in time, July of 2006, February 2007, September 2008, tended to create differences in short-term interest rates. I'm not going to dive into this. I'm going to move forward. Let's take a look at this. This is how bond interest rates get determined. So suppose the real risk-free rate of return is 3%. You can see that it goes, okay, 3%, 3%, 3%. That's what I'm expecting every year. But we have inflation. So inflation says, I'm going to have 2% inflation here. I'm going to have 3% inflation here. I'm going to have 4% inflation here. So I've got to be compensated for that inflation, which means the bond is going to should have to get a risk-free rate, including inflation. You need to factor in the inflation. So a risk-free rate on a 1-year bond is going to be 5%. A risk-free rate in this case in a 2-year bond is going to be 6%. The risk-free rate nominal on a 3-year bond is going to be 7%. This is important in theory as well as practice. So in some cases in the class, you're going to be asked, okay, you're going to borrow money for a car, and it's going to be over 5 years. What's the risk premium on the loan? How long do you think, what type of loan should you be looking at? Should you be looking, I'll change it. You're going to be buying a car and it's on a 3-year loan. What should you be using as a risk-free rate? And I say it's at 10%. So you're going to buy a new car, 10% loan. How much of that is risk-free rate? 3-year time period. How much of that is risk-free rate? How much of that is risk premium? Using these numbers here.
What would the inflation be?
So if I said you're going to have a car loan, it's 3 years. Three-year loan, interest rate is 10%. What's the risk-free rate? What's the risk premium? Using the information that's on the screen. Anybody? What's the risk-free rate, the nominal risk-free rate on a 3-year loan? On what's on the screen? 7%. 7%.
Are you adding that to your 10%?
So what's the risk premium? Now, if the loan is made to you at 10%, and the risk-free rate is 7%, what's the risk premium? 3%. So what you're looking at is essentially you're going, okay, the 10% here, if you're looking at any loan you get, you can go, okay, what's the loan? How much is the loan? Oh, it's 10% loan. What's the risk-free rate? Well, I can do the analysis. You can actually Google this stuff and go, okay, what's the expected risk-free rate, nominal risk-free rate on a 3-year loan? You can put it in Google and it'll give you a couple of answers, normally within a few tenths of a percent. You subtract it from your loan amount and you go, that's the risk. That's the risk of inflation risk, non-payment risk, liquidity risk, maturity risk, all those. Default risk. So the default risk is non-payment risk. So you can calculate the risk premium by just going, okay, what's the risk-free rate for the right amount of time? Subtract it from the nominal rate on the loan, and that's your risk-free rate. If you want to break it down further, you can go, okay, the real risk-free rate is 3%. the inflation risk premium is 4%, and the liquidity risk premium and a maturity risk premium are 3%. And you got kind of your chunks of where the price is, where the risk is to drive your return. Important thing to keep in mind. The higher the interest rates are, the lower stock prices tend to be. When interest rates are low, stock prices tend to be high. When interest rates are high, stock prices tend to be low. Why? There's a whole myriad of reasons that I'll accept, ranging from the impact to the firm to risk premium and risk-free rates. You're going to get me all excited, though. I'm going to start talking about it. What do you think? Why, when interest rates are higher, stock prices low?
Because the profits are low.
Why are profits low?
They're not performing as well.
Why?
Not enough equity.
Not quite. I won't go. I'm not gonna. You're on the right track, but you're not in the right train car. Why aren't they making as much profit? They don't pay back the interest. So the interest rate goes higher, the profit goes down, the stock price goes down. That's one really cogent, logical reason. If they have variable rate debt. What if they don't? Stock prices still go down. What if they have no debt and stock prices go down? Why? No, not necessarily. Normally when interest rates are high, the economy is doing really well. The folks are trying to, the government normally is trying to turn down the economy when fiscal policy has got high interest rates. There's some exceptions, but we'll go with that for a moment. Why do you think? What's the stock price? It's a consensus of something. The stock price is a consensus of the expected future cash flows, the net present value, the expected future cash flows of that stock, right? So we're talking future cash flow. When interest rates are high, when we calculate net present value, the higher the discount rate, the higher the interest rate that we use for net present value, does the net present value go down or go up? It goes down. So when your interest rates are high, when a net present value, the interest return is high, the present value goes down. And you can think about it this way. You go, hey, I'm going to expect $100 a year from now. If I need a 10% return because of the risk and interest rates, I'm going to lend it at, let's say easily, to do easy math, $90. If I need a 5% return, I'll lend it $95. And so when interest rates are high, that present value is low. So what happens is, since it's the expected consensus, expected value, or the consensus net present value, the expected future cash flows of that stock, when the interest rates are high, the discount rate goes up. The present value of those cash flows goes down, even if the cash flow stayed the same. So even if we take your example and we go, okay, it has no debt, so the cash flows aren't being immediately impacted, the discount rate went up because the risk-free rate, the interest rate has gone up, and therefore the stock price is going to go down because it's the expected future cash flows. Discounted, net present value, expected future cash flows, as that goes up, the value goes down. Even if those cash flows don't change, that interest rate changes. And you can see that in the Excel spreadsheets.
I'm going to probably still have the Excel spreadsheet up. You can show the example. We take this rate and go from 5%, and you see the net present value there is 843.39. If we change this to 15%, the present value goes down.
The cash flow didn't change, did it? Just the risk changed associated with the
interest rate. And so stock prices will go down when interest rates go up because the stock price is a consensus of the net present value, the expected future cash flows of that particular security, and it's discounted at a rate. And as that rate goes up, the value goes down. So it's that straightforward. And you can see that here. Now, you don't have to memorize this formula. God forbid, don't try and memorize the caret cash flow over time. But fundamentally, and you can see my little exclamation point because I get so excited about this. This is the cool stuff. The cost of money is a determinant of value. You have two pieces to the value of any financial asset. Only two. You have the expected future cash flows and you have the discount rate. One measures the performance, the other measures the risk. You squish the two together and you get the present value, what you would pay for that asset today. This is the cool thing about finance. We can price anything that way. Now, sometimes the market's not fully efficient. It's tough to price a house that way. Although if it was rental real estate, you could price it that way. You go, okay, well, the rents are going to be this much over this amount of time. I'm going to have this amount of expenses to associate with it. My net cash flow is going to look like this. And I expect the house to appreciate over time over X to Y. I'm going to sell it in 20 years. And you can come up with a net present value. And then you go, okay, is the net present value higher or lower than my cost of capital? If it's higher, then I buy. If it's not, you don't. You can reduce all these decisions to a very unemotional net present value calculation. But let's just go back to the fundamentals. You have two pieces. You have the cash flow and you have the interest rate. The interest rate measures the risk. The cash flow measures the performance. You put the two together, that's the value of the security. That's the value of the asset. That's the value of the bond. That's the value of the car. That's the value of the house. That's the value of any of that stuff. It's far easier when it's a financial asset because we're talking about the value of money and the value of money. Coming to the value of the car is a little bit more subjective because maybe you like heated seats and you have some sort of utility associated with that. It's tough to quantify in terms of dollars. But when we're talking financial assets, this is straightforward stuff. This is the fundamental of finance. If you can grasp this piece, as hard as the math is going to be, as fire hosed as this course is going to feel, if you can grasp those two components, it's cash flow, it's risk, I squish them together, I get asset value, you're winning. So much winning. So that's cost of money in a nutshell. What other questions do you have on this chapter 5 concept around risk premium, risk-free rate, cost of money, how assets are valued, financial assets are valued? Any other questions on that? Because I'll dive into some other stuff if you don't. Uncomfortable silence. Oh goodness. It is, man. I understand. I'm not going to do stock and bond valuation. See, we've got this 5, 6, 7, and 8, right? Is the next chunk. 5 to 8. So let me pull up 8. Let's talk about what risk is. Risk is the chance that an unexpected outcome will occur. How many of y'all have had quant methods? statistics. Okay. When you measure risk, what's the measure of risk? What's the typical measure of risk? When you think about how standard deviation works, you're measuring both sides of the normal distribution. You're essentially saying anything other than what's expected is risk. Risk could be upside or downside. It's any difference from what we expect. We normally in finance think about risk as, oh crap, it's not what's going to happen. It's the loss. But the classic definition of risk is, I expected something to happen and it didn't. It could have been better, it could have been worse. Either one of those is risk. Some of that risk I like, some of that risk I don't. And when we think about compensation for risk, when you think about interest rate, there's a chance on a stock it's going to overperform your. Who takes that risk? So if you said, I think I need a 20% return on this stock and it returns you 25%, so you were like, oh, well, I guess it worked out better. There was risk associated with that, right? Because it could have gone down. And the fact that it went up, the downside risk was borne by the seller. Essentially, the seller could have held that, and they said, I think it's going to be less than 20%. You think it's going to be 20% or more. You both are looking at the risk profile. One's saying, I expect it to be that or higher. One says, I expect it to be that or lower. You trade. And now you're going, okay, this is performing a little bit better than expected. The risk shifted. You basically made that transaction shift, the risk. The risk is any unexpected outcome, upside or downside. We tend to focus on the downside because we don't like bad things. Upside risk, we normally don't have a problem with. The issue is you don't get upside risk for free. You're paying for it. And normally it should be, if you think about a normal distribution, if you got upside, you got downside. Normally theoretically, the probability should be about the same. You don't always get a normal distribution. I recognize that. You can get skew, but generally that risk, if you've got upside and you go, I think that this has got a bunch of upside potential, in theory, statistically, it's got the same amount of downside potential. You're taking on that risk and you're being compensated for it. If you think it's going to go up by 20%, somebody else doesn't, because that's why it's for sale. And if you think the distribution of expected returns is normal, and you think you're going to be off on this tail at 20%, there's just as likely a chance statistically that you're going to be down here at minus 20%. So this is the probability distribution of rain or no rain. This is particularly a stock. So Martin Products and US Electric. So we say, okay, the rate of return, if it's a boom for Martin Products is 110%. If it's a normal economy, it's 22%. If it's a recession, it's minus 60%. And there's a 20% chance of a boom, a 50% chance of a normal economy, a 30% chance of a recession. US Electric is 20, 16, and 10. If you look at the standard deviation of Martin Products, you'll see here's the average, 15%. Here's the expectation in each one of those. There's the standard, or there's the difference. You square it, multiply it by the probability, and you end up with a variance of 3,517, or a standard deviation, which is the square root of 59.3%. So let's set that aside, because that means nothing in the abstract. Where's my other one? I might have pulled the wrong slide out. I'll have to calculate the other one for you. So I've got to have one hose up on every class. There's another slide that shows the other company, US Electric. It's also got the same average of 15%. but the standard deviation is significantly lower. And you can see that kind of intuitively when you look at this. If you just multiply this by this, and this by this, and this by this, and you sum it up, it comes to 15%, 15%. But this, you got boom and you got bust. Standard deviation is much higher. You got risk, right? You got upside, you got downside, but it's much riskier than this, where you've got just a little bit of upside, downside, much lower standard deviation. So when you think about risk, remember, it measures upside, it measures downside. This company, because it's got lower risk, because risk is measured by standard deviation, right? What do you think the required rate of return is on this versus this? Required rate of return on this is lower than it is on this because the risk, as measured by standard deviation, is lower on this than it is on this. And you need to be compensated for that risk. So although the average return is the same, the standard deviation, which is the measure of risk, is different, this one being significantly lower than that one. Yes, ma'am?
So the standard deviation on the market one is 88 either way. And then it's on the US electric one, it's 4 on the upside and 6 on the downside. Would that make a difference?
You're kind of backing into it.
Okay.
You're backing into it. You're able to kind of look at it and go, this is less risky than that.
Okay.
When you want to do the full calculation, you have to take the average, you subtract this from the average, then you square it, you sum it, and then you take the square root of that.
Yeah, but my question is the deviation between the upside and the downside is higher on the US electric one for the downside. So does that make sense? So it's like the same upside downside on Martin.
Yes.
And then it's less of an upside and more of a downside on the US electric. Well, the deviation is less when compared to Martin. Instead of being 15, it's 16.
Yes.
There we go.
Yes, now I'm tracking.
I'm not explaining it well, but is that something you would take into consideration when you're looking at these, or no?
No, because you reduced it to math.
Okay.
Essentially, you've reduced it to the average and a standard deviation. And the average and standard deviation, the average is going to be the same, standard deviation is going to be substantially different. And this is going to be significantly riskier because standard deviation is significantly higher than this. Other questions? So risk-averse investors require higher rates of return to invest in higher risk securities. So we talked a little bit about, maybe it's not a bad deal to go invest in that riskier stock, but you need a higher return to do it. You're not going to invest in a riskier asset without putting a little bit more, without the opportunity, without the expectation of getting a higher return. And a risk premium is the amount of the return that's attributed to the risk. So remember, when we looked at that last slide, you said, okay, here's the risk-free rate, and then there's a risk premium. And a risk premium consists of liquidity risk and non-payment risk and maturity risk and inflation risk. And those are all calculated in here. And the difference between the expected rate of return on a risky asset and on a less risky asset is a risk premium. There's a risk premium between Martin and US. There's a risk premium between a US Treasury bond and a bond of IBM. There's a risk premium between a US Treasury bond for 3 months and a US Treasury bond for 6 months, or 2 years, or 10 years, or 30 years. One is going to be predominantly inflation and maturity. The other one is going to be maturity, inflation, repayment risk, and liquidity risk. And we saw this slide in a little different format before. The important thing to keep in mind is you need to be compensated for risk. If you're taking on more risk, you need to have a risk premium associated with it, and that's measurable. Risk is measurable based on standard deviation. You can reduce most of this to math and create a premium that I'm calculating that I need is lower than what is being returned, then I don't want to buy the asset. I'm not going to get into portfolio risk. There's just too much here. I'll dive into this a little bit next class. It's another important concept, and I've got 2 minutes, so I don't want to, I can't cover it in 2 minutes. I'll just give this simple thing to think about. If I said you had a portfolio of all IBM stock, and I said you've got a portfolio of IBM stock and a portfolio of IBM and Apple stock, which one do you think is riskier? No, you can answer if you know. You got Apple and IBM in one hand, and you got just IBM in the other. Which one's riskier? Why? Yeah, so if I said, and you're right, because you've got IBM, all of a sudden you've got this risk associated with, like, maybe you got a crappy CEO, maybe you got a bad product like Unilite, where at least if you split the money between Apple and IBM, if one goes bad, the other one's not likely to go bad. Or if they both go bad, it's not going to be for a company-specific thing. It's going to be because the industry went bad. If you said I got Apple, IBM, and Puget Sound Energy versus IBM, your risk goes down even further because you've not only now not are just the computer companies, but you've also diversified the industry a little bit. You've got energy companies, you've got utility in there. Generally, and we'll get into it more, the more stocks you have, the more diversified the portfolio is, the less risky it is. Because any one company isn't going to blow up, if one company blows up, it's a small portion of it. And the market assumes you're going to diversify, so you don't get any risk premium for holding that security-specific or company-specific risk. There's no risk premium there at all. You're not getting compensated for taking that risk. The market is priced in that you're going to have a diversified portfolio. So you can take that and chew on it for the week. If you have questions, problems, concerns, hit me up by email or by Moodle or swing by my office here down in Lacey. Otherwise, have a great week, and I will see you next Monday. Yep. Thank you.
January is the longest month of the year, I think. Not only because it has 31 days, but also because it just feels so long.
You might want to get some more extra credits. But those of us that maybe a little more remedial than others.
You'll be fine. You'll be fine.
One more days of fire. One more days of fire.
I can't believe it.